Welcome to Be the Boss of Your Money. I am Mitch Goldberg, your host. This is my live stream about personal finance, about putting the personal back into personal finance. Today, we've got a couple of things to talk about. Very sleepy market, just the kind of market I like, kind of quiet, not too much action. It's a good market because we've had so much volatility the last few months. I think we need some stability to build a base. So we're going to talk about that. A couple of other things I want to share with you, a quick market update with perspective. And I want to share with you a conversation that I had the other day with a client regarding his senior citizen dad, because these are the kinds of real life topics that we need to talk about, that you need to know about, so that when you're faced with these situations, you'll know what to do, or at least you'll have a good head start in terms of starting at square one. So that's what we're going to talk about. So we are just going to make sure we are all tuned in. Thank you very much for joining me. I'm Mitch Goldberg. Let's roll the intro, and we're going to get through a couple of things here. This is going to be good. All right, we're back. Thank you very much for joining me. If you are joining us from LinkedIn, LinkedIn's been going in and out a little bit on me today, so I don't know if you are seeing that on your end as well. But this is my live stream. I'm Mitch Goldberg, and if you're new here, if we haven't met yet, this live stream is all about making you the boss of your money. That's why I call it Be the Boss of Your Money. It's about giving you the skills, sharing with you lessons that I've learned along the way as a financial advisor for over 30 years, so that you could be better with your money, so that you could make better financial decisions. I firmly believe that a better financial life leads to a better life overall. So we're going to talk about a couple of things today. If you have any questions, hit me up in the comments. I love hearing from you, and answering your questions is my favorite part of doing this whole thing. If you're watching this in the replay, welcome to you as well. And words of encouragement, words of wisdom, those are always appreciated here as well. This is going to be a quick show. It's just so nice outside in New York, and I have a feeling a lot of you might already be out, but you can watch this in the replay. So if you're watching this in the replay right now, thanks for coming by. And if you want to leave me a thumbs up, a heart, a reaction, heart, I'll see who's out there. I'll see you. I know people are watching because I see the numbers count, but I'll see your name, and it's always good to know, and I can give you a quick shout out as well. So the first thing I want to do is just tell you the quick story. A friend called me up, and this is very common, and some of you are going, wow, some of you are going to, so the first thing is a quick story. Some of you are going to find that this is quite a common theme, and some of you might think, well, we're not at that stage. You're going to be at that stage. Actually, hopefully you will be at that stage one day. So the situation is this. You have people in their 40s and 50s, and you have their parents who are in high 70s and 80s. And what happens in this situation is that I have a client's father and son, different households, of course. And the idea is that the father is getting up there in his years. He's about 85. He's doing very well, don't get me wrong. He has a lot of his money just in cash, CDs, cash equivalents. And he basically moves his money around from bank to bank to try to find the best yields on, 6 month to 5 year CDs. And as he once said to me, he feels he's so old, he doesn't even want to buy green bananas. So he's not, to him right now, 5 years is as far out as he wants to go in terms of maturity. But he does have money with me, and I know what he has. I know his overall picture. I did his financial planning. I know where all the moving parts are. Now, Sonny Boy, who's one of my dearest friends, says, hey, so much in cash. They would have had so much more. And I think my parents are just being a little bit too conservative. And I went through the numbers, and I'm like, they have enough to live on, and most likely enough to leave, a legacy. And when people are at a certain point in life, I really don't want to recommend risky securities, because they don't have the time horizon to keep moving forward. But you never know. People do live a long time. There is inflation in healthcare, food, everything we see. Prices are going up, especially now. So what we want to do is maybe what I like to do for clients of a certain age is I divide their money into 3 different accounts. One is the very short-term account, which is where they take distributions from, be it from an IRA or just from a taxable joint account. So they take their money from that account. Then they have a medium account, medium risk, that's mostly bonds and cash with some exposure to the stock market. It could be in the form of index funds, that sort of thing. And then a smaller part. So you've got the base, then the next part of the triangle, and then the top of the triangle. They have stocks, and that is the money that we do look at as a 10-year time horizon. It's not so much money that they don't need that money to live on. If you took that money away, it's not going to really change the parents' ability to pay their bills. Okay, it's not going to really hurt them, but we have that there so that if the market craters, goes down, we have a long drawn out bear market, they're not touching that money for a long time. And that's their hedge against inflation, because over time you do expect that account to go up. And it could maybe help a little bit with the legacy for the adult age children to inherit one day. And that's basically the plan that I spoke to them about. And they liked it very much. And they thought that was like father and son agreed that is a great way to go. So I just wanted to share with you one of the ways that I plan people's investment accounts in terms of their financial plans to make sure they have enough to live on and things like that, but they could still take on some risk as long as it's in a way that won't hurt their ability to pay their bills, right? So that's something I wanted to share with you. Hope that makes sense to you. If you have any questions about that, definitely please, feel free to ask me about that. So the next thing I want to do is go through a quick screen share. Pop myself up here. First thing we're going to do is look at some after hours action, the after party. Let me blow that up so you can see that on your smartphone. Okay. So Salesforce CRM came out with earnings after the close today. Stock is up almost $12 a share, almost $240 a share. That's big because this stock was in the low 200s for a little while. It's a recent addition to the Dow Jones Industrial Average. Just like you always hear, when a stock gets added to the Dow Jones Industrial Average, it's usually a sign that the stock's going to underperform for a while, as is the case with Salesforce. But now it's rebounding, up over $11, up over 5% in aftermarket trading. Costco hit earnings today. Stock is off 2.5 after earnings after the market closed. No big deal. The stock had just hit year highs anyway. But, so from 389, you see this over here, to 385. That's like a stock going from $38.90 to $38.50. Not the end of the world, but it's Costco. The stock's had a huge move. So a little sell the news is okay. Ford hit a 52-week high, $14. It hit $15.05. So it closed out at $14.88, and it's holding there in aftermarket trading. I'd recently made a post. Okay, now it's off a penny. Aftermarket trading. I'd recently made a post that, in terms of stocks getting off their lows to look at were GE and Ford. And here's GE. This stock is right around year highs as well. Stock is doing great. And you might think, oh, I missed it because these stocks were, like $7, $8 a share. But if you think about where these are from, the size of the overall company, and what their market cap is and what their business is like, these stocks could have such a huge runway ahead of them over the next 10, 15 years. That when people say, oh, it went from 7 to 14, how much higher can it go? I've seen stocks go from 7 to 14 to 3,500. That's Amazon. Okay. It was down to like $7 in the year 2000 after the tech wreck. Okay. So Boeing had a big day, helped push the Dow up. Boeing was up, if you could see that, $9.33 back to above 250. I hope it sticks this time, because every time Boeing hits 250, it backs down to like 220. But I think it'll stick this time. The airlines are flying, they're ordering planes, and supposedly their order book, not supposedly, their order book is starting to look a lot healthier. So I see a few people out there. Judy's out there. Josh, you've been consistently joining me, whether if you're listening or watching, whatever, and I really appreciate it. Let's go on major averages. This is what I like. Dow is up 141 points, up less than 0.5%. No big deal. I don't really like the days when the Dow is up like 800 points or something, or down 800 points. It's just volatility. Eventually that volatility settles down, by the way. The reason I don't like an 800-point day is because it usually gets repealed a day or two later and it drops. So I would rather the major averages build on steady gains that are durable. That to me excites me a lot more, even though it's boring to you, but that's what excites me more. Okay. NASDAQ off a drop, off 0.1%. S&P up a few points. Gold off a little bit. Oil up a little bit. Very quiet day. This is what's significant today. The VIX. You see the VIX down to 16.74. 20 is our mark. Okay. Under 20, the market could keep going higher. Above 20, the market goes down a little, pauses. Above 25, I think the market corrects. So right now we're under 20, and the VIX just has tried to get above to 20, but it didn't hold. So here's the thing about the market. Okay, the thing about the market. This was the crux of the deal today. So when I started here, I put this up there, sleepy market, and that the market has cleared a few hurdles. So the stock market's cleared a few hurdles. For example, we had the crash in crypto, and investors at large were worried that a crash in crypto would spill over into other risk assets like the stock market and pull down the stock market. Did it happen? Not really. I mean, other than MicroStrategy and Tesla, it wasn't that big of a deal. The meme stocks earlier this year took off and then cratered. Did they pull the whole market down with them? No. I mean, the meme stocks have since then recovered, and they had a good day yesterday, good day today, very good day today. But then we saw Archegos. That's the family office / hedge fund that blew up and sent Discovery Communications from the 70s down to 30, and a couple of other stocks created with that. So then, and a couple of global banks had to take multi-billion-dollar charges to help pay for that, because they were giving allowing margin. They were helping Archegos leverage, so they got stuck with the losses, and that was considered a problem for the market. But what happened? The market just went right over that. It just skipped over it like literally a couple of days, and then we had the cratering of work from home, stay-at-home stocks. The Teladocs, the DoorDashers, the Zooms. Stocks went down over 50%. Got cut in half across the board. Crazy, right? Did we get past that? Yeah, we did. We are just about ready to hit a new high on the S&P 500. We're very, very close. So the stock market has jumped over all of these hurdles. And if you notice, all of these things that I mentioned, these are all the more aggressive / speculative parts of the stock market. And they didn't spill over to the rest of the stock market. So we've gotten through the hurdles, and I think we could feel generally more comfortable about near-term volatility. So that's a key thing that I wanted to bring up. So let's get back to some screen sharing here. Let me pop myself back up here. And let's take a look at some of the crypto. So Bitcoin off about 600 or so. Ethereum was up a little bit. No, these are small moves by crypto standards. Doge was off a penny at 33 cents. I know Doge started out as a joke. Maybe it still is a joke. I'm not judging. What I'm saying is, I guess, what's the best way to put this? If people believe in Dogecoin or any other thing, then it works. I mean, what really gives you belief, or like what really puts belief into the dollar? Well, we all believe the dollar is worth something. We all believe the dollar is how we value everything, and it's a store of value. There was a time when people traded other goods, products for value as currency, barter. So it's all belief. So if somebody believes in Dogecoin, it's not up to me to decide if it's worth believing in or not. If enough people believe that something is a store of value, then it's a store of value. The dollar, what makes it different? Well, there's two things. The good thing is the U.S. government, the Federal Reserve, the Treasury, they all stand behind the dollar. They can all do something to save the dollar, rescue the dollar, print the dollar. The bad thing is they could print as many dollars as they want, and it doesn't seem like there's any cap on it, especially since the Federal Reserve's balance sheet is about $8 trillion now. And it was about $4 trillion after the Great Recession. So just a few of the things to keep an eye on. But at least the dollar does have the backing of the Federal Reserve, and it is a global currency. None of the cryptos are even close to that, so don't even say they are. And I don't see how you could consider Bitcoin a currency where one day it could be $66,000, the next day it could be $36,000. That is not a currency. Can you imagine? I sold something to somebody, for $65,000 of Bitcoin, and by the time I cash it in, it's worth $35,000. So do I call the buyer of my goods and services and say, "Yeah, you got to pony up another $30,000"? You know what they're going to tell me? That's what they're going to tell me. They're going to say, "Get lost." Okay. Let's take a look at the price of lumber. Let me pop myself up in here. Okay, so here's the price of lumber. We need to follow this a little bit more closely, but all you've been hearing about is lumber. Okay, so let me get myself in there. Okay, good. So now you can see the price of lumber. Okay, we've been talking about lumber like crazy. Everybody's been talking about lumber. The price of lumber has doubled in a year, but it was recently just about $1,700, and now it's $1,300. I don't think people realize how much lumber has declined from its very recent high. Price of lumber, by any stretch, $1,700 to $1,300 is a pretty big drop, whether if you're talking about lumber or a stock or anything else. So that is a big drop, and I think we need to pay attention to that. Just a couple of weeks ago, it was at all-time highs, and here we are, coming down a lot. Does it ricochet right back and go back to 1,700? I don't know, but I can tell you it dropped a lot, and that just goes to show you that the demand for lumber wasn't consistent enough maybe to keep the price up the way it was. So there are bottlenecks in terms of semiconductors, lumber, et cetera. We do generally in the financial world expect these bottlenecks for the most part to clear up. Now, I was with an owner-operator of an automobile dealership a few days ago in his office, okay? And I asked him specifically about the semiconductor chips, and he says, well, Ford got hit the worst. Toyota seems to be getting through it the best, but still there's a shortage of product. So there's no rebates. Cars are going for top dollar. He expects the semiconductor shortage to clear up sometime next year, around this time next year. So let's say by Memorial Day of 2022. We're just about into Memorial Day of 2021. Happy summer, by the way. So it's going to be a while, but the point is the semiconductor chip shortage, the lumber shortage, this stuff is going to clear up. Because when prices go up, supply will come out of the woodwork. It just takes a little while. And if the big drop in the price of lumber over the last week or two means anything, okay, this is just the start of what I think are other commodity goods coming down in price. That's very important to note. Okay, so let's see if we have any other housekeeping things to go over, and then we're going to end the live stream. Volume is light. The Fed is not talking about tapering. The Fed is talking about tapering, which is the same as saying the Fed's talking about tapering. So some of the big hurdles we have is, what's it going to look like when the Fed starts tapering? It might not be until another year. What do we mean by tapering, by the way? The Federal Reserve buys $120 billion worth of bonds every month. It's a gargantuan amount of buying power. And they're buying $80 billion worth of Treasury securities and $40 billion worth of mortgage bonds every month. So maybe they'll knock 10 or 20% off of each of those in 6 months or a year. We'll see. But they're going to start doing that. Okay. They're going to start doing that way before they get around to raising interest rates, in my opinion. What else? Then we have to see what the deal is with tax increases. Proposal from President Biden. His proposal is to eliminate the cost step-up basis for people who have over $1 million in assets. So I don't know if you know this, but if somebody owns assets, let's say they own a stock at $1 and now the stock is at 100, if that person passes away, their inheritor, and if that person passes away and the price is 100, their inheritor inherits the stock at $100 a share, not the original owner's cost basis of $1 a share. That's a stepped up cost basis. And if you think about, like, well, my parents bought their house for $75,000 and it's worth $1 million now, and the kids inherit the house, they would inherit it when the parents die for $1 million. If you get rid of the step up cost basis, then the price is $75,000, and now the kids owe a hefty estate tax. Potentially, they owe a hefty estate tax. That is for, let me scratch that. Let's say they bought the house for $100,000 and they sold it for $1.1 million. I think would be a better example. The point is, your first $1 million of inheritance, you get the step up cost basis, but after that, you don't. So this is really going to affect very few people, but it's going to affect a lot of business owners, people who own S corps, people who own inherited stock, family businesses, and corporate insiders. These are just proposals. We're going to find out how these wind their way through Congress. Even Democrats think that that's a little bit too aggressive all at once. So inflation, we have to find out what's going to happen with that. We have to get the labor figures. Just so you know, tomorrow is going to be Friday, the 28th. So when we all come back on Tuesday, because Monday it's a federal holiday, so Tuesday we're into June. On Friday next week, we're going to see the May employment figures. They were a huge disappointment last month, even though all of the other labor figures pointed to substantial, quick, sharp growth in the labor market. But we want to see if there's a trend developing or what. We want to see what's going on in terms of the health of labor markets. We're going to find that out. Volume is very light now, so we say never short a dull market. The market looks like it just wants to drift higher. It doesn't really look like there's much in its way. And after the hurdles it just cleared, it's hard to think of anything that's going to really knock the market down over the very near term, unless we get like just a massive jump in inflation. We already have a jump in inflation. It's got to be much bigger than where it is today, I think, my opinion. Okay. And that's about it. Work from home stocks, people feel a lot of them have gotten cheap because even though their growth is going to decelerate, they still have good growth, but the stocks, once they got down to 50% off their tops, a lot of investors feel that maybe there's some values there. And the reopening stocks continue to wind their way higher, like Johnson Controls, Honeywell, and Boeing. Okay, that's it for now. I thank you for watching. I will see you next Tuesday. I hope you have a very fun, safe, and enjoyable Memorial Day weekend. Thank you.